Rule 3. Price to earnings ratio. The price to earnings PE ratio is one of the simplest but most popular methods for valuing a stock, and this is what we will use for rule number 3. The PE ratio is simply a way of comparing the price of a stock to its recent earnings. And remember that a stock will always move in the direction of its earnings over time. When a company makes money, its stock price will eventually go up, and when a company loses money, its stock price will go down. That's how simple it really is. So if a company has a stock price of $40 and reports earnings per share of $2, it has a PE ratio of 20, which essentially means that if you buy the stock at the current price, you're prepared to pay for 20 times the recent trailing earnings. Historically, stocks have averaged a PE ratio between 15 and 20, and if you look through a large table of companies, you'll find that most stocks sit somewhere between this range. Benjamin Graham, who was Warren Buffett's teacher, said that a PE ratio of 8.5 indicates a company where the market is pricing in zero growth. Meanwhile, a PE of 18.5 indicates growth of 5% a year, and a PE of 48.5 indicates growth of 20% a year. So let's look at an example. Here we have the PE ratio for Delta Airlines, which is currently 29.12, and you can calculate that figure yourself by dividing the stock price by the EPS here. So in this case, a PE ratio of 29 means the market expects Delta Airlines to grow its earnings roughly by over 10% a year, and this essentially means that investors are paying 29 times the airline's recent earnings, or paying $29 for every $1 of earnings. So let's take Delta again. If you factor in things like the oil price, the size of the company, and the global economy, is it reasonable to expect the company to grow at over 10% a year? I'd suggest probably not. A growth rate of 10% a year might not sound like a great deal, but in reality, many companies, particularly larger companies in competitive industries, fail to achieve that amount. Companies do not always make money in a given year, so getting a growth rate over 10% is not actually that easy. Sure, an exciting company like Tesla might have been able to grow its earnings by over 20% during the last 5 years, as you can see here, but there comes a time when that growth will always slow down and the stock price will have to adjust. No company can keep its growth going exponentially. Growth versus value. So for certain growth investors, a PE ratio of 29 might be perfectly reasonable, and the importance of the PE ratio, like all ratios, will depend on the industry. Indeed, a high PE ratio can indicate a company is growing fast, whereas a low PE ratio can indicate a company that is doing poorly. There will always be differences in PE ratios, which may stem from market expectations, random fluctuations in earnings, or seasonal factors. And it's for that reason why we combine all of these financial ratios together to form our composite strategy, as no one ratio on its own is very useful. It's also important to note that PE ratios and dividends are related, so when the PE ratio falls, the dividend per share normally rises. But all of that aside, as value investors, we prefer to look for stocks with low PE ratios. Lower PE ratios means low expectations, and low expectations are easier for us to beat. There have been numerous studies over the years that support this theory, and shown that low PE ratios stocks do better than stocks with high PE ratios. So rule number 3 is this: PE ratio is below 10.